Good afternoon. My name is Ala McCoy. I am Director of Startup Support at the University of Maryland's UM Ventures. And today we will discuss a business lingo for new startup founders. The reason I prepare this presentation is oftentimes we have, I'm working with scientific founders, scientific startup founders, or people who don't have formal business education, and they find business terminology used by investors, by bankers, by other people within the startup ecosystem to be very confusing. And so today's workshop is meant to go over this terminology, these terms, very, very superficially. So we will touch base on a lot of terms, a lot of concepts, but very, very briefly and very, very quickly. And however, throughout the year, we offer workshops that delve in a lot of these topics in detail. So if you're interested in some of these, please feel free to sign up for workshops that discuss these topics in details. We also have been recording these workshops and posted many of them on our Startup UMD YouTube channel. So you can also browse for content there if you're unable to attend a live workshop or can't wait until the live workshop comes around again, is going to be offered again. So again, we will touch on a lot of these concepts very, very briefly. Feel free to stop me and ask questions if you have any throughout the presentation. I'm going to be happy to indulge or answer any questions. However, we're not going to have time to spend a lot of time on any one topic. So I may refer you or send you a link to a workshop that you can attend live or watch a video. So we'll start with startup communications. So you have a business idea or you already started a company. First and foremost, you should be able to talk about it. What do you need for that? And what you might be asked for. So first, you should always have prepared an elevator pitch or a one-liner. It's usually a very brief description. It should be very simple, describing what is it that you do in your value proposition. It's not meant to give a lot of details, and it's not meant to generate, immediate investment interest, for example. But if you're successful, what you should be getting is I'd like to learn more. Can you please tell me more? Here's my business card. Here's how to get in touch with me. I'd love to learn more about your company. Or they might ask you to send them your investor pitch deck or your pitch deck or executive summary. And here's what to expect. So usually an investor pitch deck or a deck, usually it's somewhere between 10 to 20 PowerPoint slides describing what your startup is and does. And things that should be included in your investor pitch deck are what is the problem that you're solving? How big is this problem? Meaning how big is your market? What is your solution? And why is it better than everything else out there? How do you plan to operate your business? And what's your go-to-market strategy? What are your financial projections? Very, very simple. And most importantly, why you, what is the team that you built, and why is that team going to make this a success? Usually you will be told, or you will be informed how long of a pitch deck the investors or others are expecting, so you would know. There are also two types of executive summary documents that you should have on the ready. One is a very short executive summary. It's also sometimes called a one-pager. So it should be 1 to 2 pages, no more than that, very briefly describing what you would describe in your investor pitch deck. You should also have a longer version of executive summary, somewhere, up to 15, maybe 20 pages, but no more, providing more details about your startup's business model, goals, possibly market research and things like that. And the goals for your company, how do you plan to achieve them? So nobody writes lengthy business plans anymore. Nobody reads them. It used to be in the past that people would write 100-page business plans, and nobody does that anymore, but you should have a shorter and a longer version of your executive summary ready. And we'll talk about different corporate structures. So you're thinking about a business. How do you form it? So there are many types of different corporate structures that you could organize your business as, and we'll talk about the most common ones that you might hear about. Sole proprietorship is basically a one-person company. Owner is personally liable for everything, and owner's assets may be used to pay company's debts. Company finances flow through owner's personal finances. The next step up is limited liability corporation, and that's usually most companies start out as an LLC. In this structure, owner is not personally liable for the debts unless there were personal guarantees that were signed. That's the big distinction between sole proprietorship and an LLC. However, company finances still flow through owner's personal finances. You're not liable. However, when you do your taxes, or when you do your company's taxes, you basically do it as they flow through your personal tax return and such, and you can use your personal bank accounts to do financing. Sorry. The next step up is a corporation, where it's a structure where both liability and personal finances are completely separate from the owners. Usually you would be asked to convert from an LLC into corporation when investors come on board, or when the company grows and it becomes too cumbersome and too difficult to keep the company's finances not separate from personal finances. Sometimes, if you know you're starting a high growth startup, it's advisable to start it out as a corporation right away, because there are some tax ramifications for you and for investors, and you can discuss that with your attorney. And then, of course, there are nonprofit organizations, and these are organizations or companies organized for public or societal benefit rather than for shareholder benefit. And the big difference here is that these types of companies are subject to non-distribution constraint, meaning that any profit that organization made cannot be distributed to the owners. They have to be reinvested back into the company and directed to the company's main mission. There are other variations of corporate structures. There's low profit organization, which is a combination of corporation and nonprofit, and there are some of the others, but these are the most common ones that you might hear about. If there are any questions, please let me know. Now we'll talk about different types of startups or businesses. So if you are building a high growth startup, and you may hear this term, high growth startup, it's a newly formed company that has a very scalable business model. It's usually positioned to acquire large market share very quickly and grow to revenues of 5 million and above within the next 5 to 8 years, of course, depending on the industry. This is the type of company that investors such as venture capitalists and angel investors invest in, and this is the type of company that's positioned for either acquisition or IPO. So you would be expected to either sell it to a larger company, or do initial public offering. And that's why investors invest in companies like that, because that's at these events is when they actually make money. Lifestyle business is a company that's not positioned to be sold quickly. It is sort of in its description. It's meant to be a business or a job for the owner for a long time. Usually, it's a company with a business model that's very difficult to scale, or it could be that the owners just don't want to scale and grow it beyond what it is. Examples could be chef-driven restaurant or family-owned restaurant. You have one location and that's what you operate. Could be spa, photo studios, small consultant firms. Consultant businesses are hard to scale. So these are usually small lifestyle businesses. Nothing wrong with either of the structures. It's just that they are different in how they're operated and how they finance their operations. So an investor would not invest in a lifestyle business, but they would invest in a high growth startup. Now, there's also a third category called organically grown company. This is where business financing growth solely is growing. Business financing growth is solely through its own revenues and not taking any outside financing. This sometimes happens. It's rare that these types of companies become high growth startups. Usually you will see this in the lifestyle business. However, there are companies like that. For example, Dyson is organically grown. They never took any outside financing. A lot of times, or sometimes, software companies that don't require a lot of capital to grow will choose this route because they don't want to dilute their equity and want to keep control of the company. Again, there's nothing wrong with either of these types. It's just that it's important to understand the distinction. And there's a question: can you use your own assets to pay company debts in an LLC? Yes, you can. You basically would. You can use your own assets to pay company debts in an LLC. You would basically record it as either a loan to the company or capital investment in the company, depending on how you want to be treated. But definitely, yes. Now we'll talk about business models. So a business model basically describes what is your plan to create and deliver product or service to customers or users. How do you plan to finance the company's operations and generate profit or finance its daily operations in case the company is a nonprofit. So oftentimes when people are building a nonprofit, they don't think about this because they think, well, I'm a nonprofit, I don't need to make money, but you still need to be able to pay for your daily operations, and where that money is going to come from. It's a very important consideration for any company. Business model canvas is a tool that can be used to design and kind of play around with your business model. It is used in NSF I-Core program and many other programs that are based on lean startup methodology. You can find it online. There's an app. It's a great tool to think about your business model. Now we'll talk about various business models. There are hundreds of them. New business models are being developed all the time, but these are the most common ones that you might hear about. So B2B or B2C. B2B, business to business, means that your customers or the company's customers are other businesses. So for example, Boeing makes airplanes and sells them to airlines. WeWork is a company that rents spaces to other companies. Sometimes business will have B2B and B2C models within the same organizations. So B2C, your customers are individual consumers. For example, Under Armour sells consumer products. Nestle sells consumer products. However, Nestle also has a B2B business where they sell supplies and such to other businesses. So they have B2B and B2C business models. They're run differently. They have different margins, different economics, different operations. So it's important to understand. Subscription business model, services or products are sold on a subscription basis. For example, could be weekly, could be monthly, annually. For example, we subscribe to Hungry Harvest, whereby every Wednesday we receive a box of fruits and vegetables. It comes every Wednesday. We can cancel it. They have our credit card. We can cancel it and such. Adobe Creative Cloud is another example where you subscribe and you have access to Adobe services. X of the Month clubs, Wine of the Month, Bacon of the Month clubs, and such, all examples of subscription services. Investors love these because especially in cases where subscription is not very expensive, people forget to unsubscribe or cancel their subscriptions, or they just never find the time. And so and it also is a guaranteed way to keep your customers. You don't have to market, you don't have to spend money on marketing to your existing customers. You already have their payment, and you have their attention, so you can keep marketing to new customers. SaaS, or software as a service, it's usually monthly or annually subscription to software. So it's again, subscription, a variation of a subscription business model, but specifically for software. Freemium or premium business model is used very successfully by companies that offer basic service for free, and then they charge for additional features. For example, LinkedIn, anybody can get on LinkedIn and use it. However, if you would like additional features, such as to see who is looking at your profile and such, you have to pay LinkedIn Premium. And not everybody does that, not everybody finds value in that, but you already have people on your network, you already have people using your services. Chances are they might pay for a premium service. A lot of apps and video games use this business model quite successfully. Direct sales is another model. Sales reps sell directly to consumers, completely avoiding retail and middleman. For example, Avon, Tupperware, Mary Kay are typically not sold in stores, and you buy it directly from the sales rep. There's nothing wrong with either of these business models, or the ones, there are many more that we haven't discussed. It's just a good way of thinking, how is it that you will be operating? So platform marketplace is a business model that developed in the last decade very rapidly. Amazon is a great example of that. And so this is a model where a company is offering opportunity to others to use the platform to make or sell their products or services. So for example, Amazon.com started out as its first customer on its own platform, and then they opened up their marketplace to other sellers to come and put their products, not only the marketplace, but also their entire distribution system, warehouses, delivery mechanism, and such. It's very hard to build, and people find it useful and jumped on that platform. Google Play, Apple Developer, iTunes, Magic Leap, and many others offer a platform where people can put their products and services, either use the building tools, developing tools, and then sell them. Another model is called razor blade model, loss leader model. There are a few other names for this, but the basis is you sell a fixed part or of equipment at a cost or even at a loss, and then charge for recurrent supplies. For example, printers are usually sold at cost or very cheaply. However, then you have to pay premium through the nose for ink cartridges. And in fact, ink is one of the most expensive liquids that you could buy. Blade, you would buy a shaver blade in a store, and then you have to go back and pay a lot of money for the razors that go with that particular blade. Game consoles and games, lab equipment, many of you operate labs, so you know that lab equipment comes sometimes not very expensive, however you have to pay through the nose for supplies. Again, investors like this model because once somebody makes an investment in the fixed portion of the equipment, then they keep buying the supplies at a premium. And again, that's basically people who have your fixed part are your natural buyers. You don't necessarily have to market a whole lot to them anymore. And speaking of market, so we'll talk about market now. Again, if you have any questions about business models and anything else, please submit them either via chat or Q&A. So when we talk about market, one of the first things that we do, we usually should be doing customer discovery. Customer discovery is a term used in NSF and regional I-Corps programs. However, it is now also widely used just everywhere. So it's a process of creating a hypothesis of who your customers are. Why do you think they are your customers? How much are they willing to pay? Why? What features are important to them? How would they use your product? And then, so you make all these hypotheses about your customers, and then you test it by conducting a series of interviews with potential customers. Customer segment, a group of customers who share a defined set of characteristics. It could be geographic location, could be income, education levels, gender, age. The more specific you can get in describing your customer segment, the better you are in understanding who your customers are and how they behave. And a lot of this could be achieved through customer discovery. Value proposition is a very important notion. It's a statement explaining why would your customers want to buy and use your product or service. And typically your value proposition is centered around better, cheaper, faster. It's usually not a description of how your technology or how your product works, but more, and not even what it does, but what value does it deliver. So for example, when you go to Home Depot and you buy a drill, you don't necessarily buy a drill, but you buy a hole in the wall. So what is it, that hole in the wall that you are doing? Describing that is what your value proposition is, and how do you achieve making that hole? Could it be done faster? Could it be done cheaper, easier? So if somebody comes up with a product that can make that hole in the wall better, cheaper, and faster than the drill, then people will probably switch to that product. Competitive advantage is Why is it that your product or service better, cheaper, faster than any other solutions on the market? And that's always a big mistake to say, oh, I have no competitions, no competitors. There's always indirect competition. And you should understand your competitive landscape, such as direct and indirect competition, description of who else is solving the same problem as your business, their value proposition, and differences and similarities, and again describing why is it that your solution is better. Product market fit is something that investors, potential buyers always looking for. So it's product or service that satisfies a continuously strong demand in a defined market where customers are willing to pay enough to sustain a profitable and scalable business model. So this is a very, very important notion. Another term you might hear is TAM. Tell me what your TAM is. TAM stands for total addressable market. And the keyword here is addressable. Number of customers who have a need for your specific product or service, but also who you can reasonably market and sell to. One example would be, for example, if you are opening a restaurant serving French food, not only you would need to find out number of customers who like the food that you serve, can afford it, but also people who live within the driving distance. So even though somebody might like food that you sell and they live in California, they're probably not going to travel to your location in Maryland. And so how many people can you, so what is your total addressable market? How many people are you going to be able to reach and get their attention and also service? Proof of concept. It's a process that proves or disproves product market fit. So for example, if you are trying to open a bakery or any type of new food business, you might want to start selling your goods at the farmer's market first at a table to see if there is a demand for your products, people like them, and if they're willing to pay money enough to actually make you profitable. Or for example, another example would be providing a service as an in-person consultant before you actually spend the time and money into creating software that does their job. So proof of concept in business is somewhat different from proof of concept in technology, and we'll talk about that a bit later. When you discuss an industry, or when you hear others discuss, you might hear industry could be fragmented or consolidated, concentrated. So fragmented industry means that there are many small companies competing in the same marketplace. Usually these are small, either very young industries that haven't had a chance to get consolidated, or the ones that are difficult to scale and grow into a larger company. So an example would be translation agencies. There are lots of small companies because it's just difficult to scale anything that has to do with consulting. There are a few large consulting companies, but typically there are lots of also smaller ones. Consolidated or concentrated, a few large companies competing, and usually it indicates a mature industry. And any type of market acquisition strategy is usually achieved through mergers and acquisitions. So you can look at grocery stores, for example. The only way they could grow is just to buy each other out. Also, when you're talking about market, you might hear, or even your company, you might hear the term called CAGR, which stands for Compound Annual Growth Rate. It's usually used to describe industry or company growth. So you want your CAGR to be positive and not negative. And different industries have different standards, but the reason I listed here is because you might hear that, so you know what it stands for. So now we'll talk about sales. Every company exists to make sales. There's nothing, the company doesn't exist without sales. So this is really important. So first to understand is a sales cycle. It means the length of time it typically takes to sell something to a customer. If you come to a Starbucks, your sales cycle is typically very short. You hand your money, you place your order, you hand your money, and they hand you your product back, and that's your sales cycle. However, if you are Boeing and you're trying to sell airplanes to airlines, that sales cycles usually takes years to find potential buyers, negotiate the terms, deliver the product, and collect payment. That usually takes years. Now, these are two extreme examples. Understanding what sales cycle is within the customer segment to where you will be selling is very important. So for example, for those of you who work at the University of Maryland, you know that if somebody is trying to sell something to the University of Maryland that's over $5,000, that's a longer procurement process. It would probably need to go, if you're trying to sell something to me like that and I want to buy it, it would need to go on my next year's budget. I would have to go through a longer procurement cycle process, and so it would probably take you a year or two to actually sell me something like that. If I need to buy new paper for the printer, it's going to be a very short sales cycle. So understanding how long it's going to take you to sell something to your customers is a very important part of your business model. So customer lifetime value is how much money will a typical customer spend at your business in their lifetime. It's another very important notion, so that for your planning purposes. In a lifetime, how much money would a typical subscription customer would spend? Or if you're a Starbucks, they understand how much they can get out of their typical customer. Customer acquisition cost means marketing and promotion costs divided by the number of paying customers. So for example, you spend $1,000 on a marketing campaign and you got 1,000 new customers out of that. That means that your customer, it costs you $1 to acquire any new customer. And that needs to be taken in. You need to take that into consideration when pricing your product or doing your projections. So sales pipeline or weighted sales pipeline, number of prospective paying customers times the dollar amount of prospective sales, and you can also weight it by probability of closing the deal. So not everybody is going to buy your product. Not everybody, something's going to happen to their budget. Their budget's going to be cut. The person you were talking to could leave the company, and then the next person managing that department may not be interested in your product, so things happen. And also how far away you are from closing the deal is another way to weight that prospective sale. But when you're talking to investors, they would not want to know how many customers do you have in your sales pipeline, and how likely is it that you would actually close the deal, and when do you expect those deals to be closed. So understanding sales cycle, customer lifetime value, very important here. Let me see, I don't see any questions, so we can continue. Another sales term that you might hear is MRR. It stands for monthly recurring revenue. It means the amount of revenue generated by recurrent customers where no additional sales or marketing efforts are needed. An example could be if you have a SaaS or any other subscription service, what is that monthly recurring revenue? Or how many customers are your regulars for your restaurant, your coffee shop, that are coming in without any additional effort. Obviously, the higher that number is, the better. Conversion rate is very important for freemium type of businesses, or for those that offer trial subscriptions or trial, some kind of trial to their customers. So how many customers actually, or what percentage of the customers convert from that free trial to paid, or from freemium to premium. So basically, how many paying customers do you get? Customer churn, how many recurrent customers drop off at a given time period. So nobody stays or almost, I should say, nobody stays a loyal subscriber for a lifetime. At some point, people drop off, or they no longer need the product or service, they move, they retire. So understanding what that percentage is really important. And CRM is customer relationship management system. It can be operational and analytical. Operational is where you record your customer relationship interviews, your complaints and things like that. And analytical is a system that analyzes your customer relationships. So both are important for any business. Any questions? Don't see any, so we can move on to the product, the end product that comes out of sales, hopefully, money. So in any conversation about startups, you will hear these very important terms, or might be asked about these, might be asked questions about these things. So burn rate, it's a startup term, very specific startup term. Basically, how much money your startup is spending per month, and more importantly, how much money your startup is losing a month. That's why it's called burn rate. You're burning through the money. And so when you are asking investors for an investment, you're asking them for $1 million, they would like to know, what is your burn rate, meaning when are you going to run out of this money before you actually start making any profit. So really important to keep your burn rate low. However, as low as you can. However, if you do need to spend money on R&D, on sales and such, and so investors understand that, but they need to know that number. Revenues and sales, it's number of products or services sold times the actual price charged, minus any type of returns that you received. Revenue streams, sources of revenue for your company. And company could have several revenue streams. So for example, you could have revenue from the sale of your hardware, and also from consulting services. Or you could be selling hardware, and you could be also charging for installation and other add-ons. So it could be various revenue streams. EBIDTA, it actually is a accounting term, but it stands for earnings before interest, depreciation, tax, and amortization. And any potential investors like to see this EBITDA table because it's a very simple table that shows earnings of a company regardless of its capital structure. Very early in company financing, um, or even further down, there might be debt, there might be equity. The company's operations could be financed in different ways, but this basically removes the capital structure considerations and shows, are you actually going to be making money and how much? So usually you would use an EBITDA table on your pitch deck and also on your executive summary. It's very concise and a good way to illustrate, very simple way to illustrate how much money are you planning to be losing or making in the next usually 5 to 7 years. When you're talking about costs, it could be costs could be variable or fixed or overhead. So variable costs, costs that change with the change in the amount of products or services produced. For example, if you use more materials or you have hourly, you pay your employees hourly to make or put together your hardware or your products. So those are variable costs. They can be attributed to each new item or new product or service that you produce. Fixed or overhead costs stay the same regardless of the amount of products or services produced. For example, rent, you still have to pay rent on your office or your store, your warehouse, regardless of the amount of products that you actually have there or produce there. Capital investment, purchase of large equipment, full-time employee salaries and such, those are fixed. And there are various accounting philosophies on how to attribute those to products. We're not going to go into that in this presentation. COGS stands for cost of goods sold. That's an important notion. So COGS are calculated where you are taking variable costs plus variable labor attributed to the product sold. So basically, how much did it cost you to make that one unit of product or service? Operating income is something that investors use to look at a business, the health of a business, whether large or small. Revenues minus cost of goods sold minus full-time employee wages and minus depreciation and amortization. So this basically shows you the health of the business model, again, regardless of its capital structure, regardless whether there are other interest charges, finance charges, or investment income and such. This is basically shows you the health of the business operation. Profit margin, revenues minus COGS, revenue minus cost of goods sold. Each industry has standard profit margins that are acceptable. So in a restaurant industry, you want your margins to be 30%. Food costs, you want to be 30%. Other industries have their own standards. Sunk cost is a very difficult notion. It's basically an investment or cost that cannot be recovered. Sunk costs should not be considered in making decisions about future strategy. And there are many examples of when sunk cost basically destroyed a business. So one good example is Kodak, when they refused or decided they weren't going to switch to digital photography and they would continue making film because they already had filmmaking facilities and made investment in those filmmaking facilities. We all know what happened. With that, let's see. I don't see any questions, so we'll continue. Now we'll talk about investments or outside funding. When you think about investors, there are two major types that you usually think of for startups. It would be VC or venture capitalist and an angel investor. An angel investor usually comes first in that investment timeline. It's usually a person investing in high growth startup, his or her own money, personal money, in hopes of high return. Typically, they invest in an earlier stage than VCs and venture capitalists because, well, A, they invest their own money, so they are, they feel like they can take more risks with it. And they usually typically invest in startups where they understand the industry and where they can also provide introductions and such, or mentor the company. VC or venture capitalists, they invest other people's money. They invest, again, also in high growth startups on behalf of an investment fund in return for equity in hopes of high return. So both VCs and angel investors take equity or shares of a company for their money, and they usually, the way they make money is when the company is sold, and hopefully their shares go from being very inexpensive to then making them 10x or more return on investment. There are several investment stages: seed, pre-seed, seed. Usually that's where angel investors invest. And then when you hear Series A, Series B, that's where venture capitalists come in, or it's also called institutional investors or institutional money. Dilution, it's when a company issues additional shares to new shareholders, such as new investors or key employees, and these additional company shares reduce percentage of a company attributed to each share. So if you are the sole owner of your startup right now, if you bring in an angel investor, then your share will be diluted. With each new investment into the company, the original shares are diluted, or equity investment, I should say. There is non-dilutive funding that does not require equity in return. For example, SBIR grants or grants, they don't require you to give up equity in your company. Bank loans don't require giving up equity in the company, or any other loans. So there's also non-dilutive funding. And so when investors are looking at your company, they will be talking about valuation. It means how much your company is worth. And there is pre-money and post-money valuation. The easiest way to explain it would be just to give an example. So for example, investor offers to invest $1 million for 25% equity in your company. What that means is that now the investor put value on your company, meaning they say your company is worth $3 million pre-money and $4 million post-money, if of course the deal gets done. In cases where the startup is really early and it's really difficult to come up with the valuation at that stage, usually mechanisms such as convertible debt note are used. Basically, it allows you to avoid calculating valuation at an early stage, and it's a promise to convert into that this convertible debt note would convert into equity during the next round of financing, where hopefully your company is further developed and you are and there is a better idea of what the valuation is. Or it could also be paid back like a regular loan. A safe note is a variation of a convertible debt note. A safe note is simple agreement for future equity. It is the biggest difference is that there is no option for this to be converted into debt or into loan. So it can only be converted into equity, and that's it. So when you're talking to investors, they will always want to know what is your exit strategy. So if you're taking investor money, your high growth startup, and investors get paid when there is an exit event. So they would want to know what is the strategy, which large established companies will buy your startup, or is IPO a reality? Use of funds, very important to talk about that in your pitch decks. How much money are you asking for, and what are you going to do with that money? And why do you need it? Where is it going to get your company? Cap table, it's a table showing individual owners of the company with percentages and type of equity. Equity pool, company shares reserved for future hires. When you're very early in a very early startup, there's usually an equity pool reserved for new hires because usually you can't pay market rents, market rates, market salaries to the CEO and the CTO, and you want to entice them also with equity. Term sheet is an investment deal proposed by investors. Now we'll talk about technologies. TRL, you probably all know and familiar with this. It stands for Technology Readiness Level. It's a measure of maturity of a technology. Now we talked about proof of concept in business. There's also proof of concept in technology. It's a demonstration of feasibility of an idea, showing that your idea can actually work, or your technology can actually work. MVP, you will hear that term a lot. It stands for minimum viable product. It's basically a version of product or product design that can work as a real product, a beta product, for which customers would be willing to pay. Basically, what is the minimal development do you need to your product where it can pass as something that you could sell? IP landscape is an analysis of patent, copyright, and trademark secrets owned by you and your competitors, and where do you stand? Now, most important is people within the company. So when investors invest in your startup, they most invest in people. So there is a founder of the company. It's a person who came up with the concept and legally formed the company. There could be several co-founders. There's management team, chief executive officer, chief technology officer, and such. Founders could be playing any of those roles, but not necessarily. And investors, individuals, or organizations financing companies' operations in return for equity, interest, or other form of compensation. Now, there are also boards, company boards, board of directors and board of advisors. Board of directors are basically people who supervise and manage the CEO. They have fiduciary responsibility to the company, and they represent shareholders' interests, make strategic and other important decisions. Board of advisors do not have fiduciary responsibility, and they are a group of individuals selected by company's founder and also or management team to provide advice. Early stage companies usually use board of advisors to earn credibility and to supplement their knowledge and network. Typically, board of directors is compensated. Both board of directors and board of advisors are compensated either through cash or some equity in the company. So we are unfortunately at time. I am happy to stay and answer questions if anybody has any. Again, this was a workshop where we ran really quickly through a lot of notions, terminology, a lot of interesting topics that are covered in upcoming workshops. So you can visit the website to register for those workshops, or the Startup UMD YouTube channel offers recording of our past workshops where you will be able to explore some of these topics in depth in recorded workshops. Again, thank you so much for tuning in and for staying. I apologize that we sort of ran out of time, but I am happy to stay if you have time and answer any questions that you may have. All right, I don't see any questions. Thank you very much for tuning in, and have a good day.